trading pre-market and regular session liquidity. All right, so we're looking at the NASDAQ here on the left-hand side is a daily chart. As you can see, everything I've been teaching so far this week has been panning out to script. And the right-hand side chart is a 1-minute chart intraday for today's price action. So I want to take your attention to this candlestick here. This is a premium wick. Now, I mentioned in the first session Tuesday about how the rules for when you're trading all-time highs or near all-time highs, you need to be grading all of the premium and discount wicks. Here, that's 2 days ago. So when I said in the notes to cut through candles, just go over top this candle like it's not even there and go right to it. It doesn't matter if there's 5 days. It doesn't matter if there's 4 days, if it's 1 day. You look back during the series of the run in the all-time highs or near all-time highs in close proximity to where you're trading at now. If there's any premium wick or discount wick, you need to grade it. And we run the fib on it. So it gives us the 25, the 50, and the 75 level because these are the things that I used. So you want to grade those premium wicks. This dashed line here is this dashed line here on the 1-minute chart. And then in the upper quadrant of this wick, okay, the only thing we've done here is lay the fib on this candlestick's body to the high, noting the 75, 50, and 25% levels. The upper quadrant level of this wick, that's this level right here. And that's going to be pertinent in a few minutes, but for right now, that's all you need to know. And these levels are no longer important for the rest of this production, but I'm keeping it here so that way you can track where everything is. When it's salient, I'll just highlight this one purple, and I'll remove these to draw your attention to what it is I want to show you. All right, so we have pre-market start. Okay, so this is pre-market session start or open at 7 a.m. That's what the equities market is. And you can see how we had this really obvious smooth edged buy-side liquidity pool left there. And I mentioned on a very short little vignette, and I'm not going to include it here because it's for people that watch and follow me on X, how I found this run here up into that liquidity pool. So everything above these relative equal highs, all of this in here was retail getting trapped offside. And then they were going to drop it. I know you're going to ask me, how did I know that? Because it's Thursday. Thursday is the day right before Friday, obviously, and the week ends and we can't trade anymore after 5 o'clock on Friday. So when we have a really bullish week, as we've seen so far this week, it tends to create these either the high of the week forms on Thursday, or it'll create these fake highs of the week, and then it'll come back raging and blow out the high like it did today. So I like to look for scenarios like this where they prime the market, so retail sees it as resistance. They drop it down, so they think it's going to go lower. Then they run up here and gather all the buy stops that they left here, trying to short it prematurely. So all of these little runs in here is just them accumulating short positions to trade down to the lower quadrant of that premium wick. So when price ran above this high here, I was really interested in seeing that as a short. Why? Because we were going into the 8:30 news injection where we have volatility flood the market. And it's all during a time when I anticipate this being manipulation and accumulating short positions by smart money, which will be distributed lower, offsetting here at minor sell side, at pre-market session sell side. And having an expectation of lower prices on a day when you're primarily bullish, you have to know exactly where you want to get out at. Otherwise, you'll marry the idea and stay too long. So continuing on here, we're going to move a little bit forward in time. So this is the pre-market session start, or 7 a.m. The consolidation around the buy side where it accumulates it. And then right before the 8:30 news, they rally it up, taking out this short-term high and this high here. I want to be selling short right there. Even if it stops me out by running higher, it doesn't matter to me. It's just one of those things where you're wrong. But everything here was suggesting, because it's Thursday, they primed the market, early on in London, and then 7 o'clock, they ran it up, did not break it down here, kept holding it. 8:30, as we approach that, that's going to be the next wave of basically a price run. So we had one starting at 7 o'clock. It ran into the liquidity. And then at 8:30, we're going to see a more significant intermediate term price run intraday. Then we have that here. Market breaks down. It consolidates and spends a little time in here. It finally gives up the ghost and trades lower, hits the first minor sell side liquidity pool, and then trades down to the pre-market session sell side liquidity pool. And that buy side liquidity pool, I just highlighted it over here so that we can reference what this was all about. So time, and then price, and then liquidity. Where's it going to draw to? Here. And then draw down to here. And moving forward, you can see this was a reclaimed bearish fair value gap. As I mentioned during the recording, I highlighted it and showed you that's why it was pausing in here. So this is time distortion inside of this fair value gap that we went above once we got back down below it. Now this is a reclaim. It's not an inversion fair value gap. It's resuming its original characteristic at the formation of it, which is a SIBI, which is bearish if you trade back up to it. Well, we're trading up to it here. It's consolidating, and there's a smaller little one inside this little area right in here. This pre-market session buy-side liquidity pool was created in all of this consolidation, and that's right there is where I was going short. You can see it in the recording. The market breaks lower. There's a small little fair value gap in here right at that low. Really nice little drive up into that. And then this is also an inversion fair value gap, which later on after the regular trading session begins at 9:30, it trades up into that. I'm showing you where I entered short. I added all in here inside that reclaimed bearish fair value gap, and then it broke lower. And then the limit order, which is what you watch in the recording, gets filled here. Now, why didn't I hold for this objective or this objective if I'm going to sit here and talk to you like I'm sounding so smart, right? Well, it's going against the underlying macro direction on the daily chart. So I know I'm going against the grain. So I want to be nimble and pick a low-hanging fruit objective to get out at. That means the pre-market session, sell side liquidity pool, the low here, that's the easiest thing to reach for. And it's a no-brainer. It really offers a good reward. The risk was minor compared to the reward here, and it's high probability. It's not high probability to see it drop like this and expect it to trade down to Monday's high, which is right here, or reaching down into the upper quadrant level of this wick, which would be this level here. So notice while I got out here, it dropped down further, but then failed to get to that level there, which is this candlestick's high of that premium wick. So by it not getting there and then retracing all the way back up and all this messy price delivery, I say that with tongue in cheek, but it reaches up into the inversion fair value gap and then comes back down and takes out these relative equal lows, digs into that upper quadrant level right here during the regular trading session. So here's that regular trading session start time. We have a minor sell side liquidity pool here, relative equal lows. And then we have this minor buy side liquidity pool, which watch what it's doing here. While it's consolidating at 9:30, it drops down first. That's a fake out. Then it drives up into the inversion fair value gap, trapping what? Breakout artists that want to be buyers. Then they rake them across the coals to take out the sell side here and dig into this candlestick's high, that daily high, the dashed line, and then into the upper quadrant level of this premium wick, which is this 24,619. Once it trades there, then there's a rejection away from that. Then we have a nice little sugar rush where it runs right back over top of everything that was given and attacks the remaining stops here. Why? Because the market's primarily bullish. I mentioned this on Tuesday. Avoid, when we're in all-time highs, avoid trying to pick the top. This is classic bait and switch. This is exactly what they do all the time. And they come back down and touch that old daily high. That's this high here. Retraces lower, then rallies, and straight drive all the way up to clear this liquidity over here. Notice these quadrant levels in here. It trades up into the lower quadrant of this buy side imbalance, sell side inefficiency, which is the inversion fair value gap. So it hits that here as the opening range high. It drops down, hits the objective of the upper quadrant of the premium wick on the daily chart there, and then finds support and discount sensitivity at this candlestick's high, the wick high, and then starts to rally. This is the first percent of fair value gap. I'm showing with the volume imbalance here, and there's a small little volume imbalance in there. Project that forward. We trade through it, come back down, use it as a discount array, and then sends it higher. Now, I've taken away the other quadrants on that premium wick, as I mentioned earlier that I would, and changed it to like a purple color. And that's it right here. So you can see clearly it drops down into that. Inside this range of the daily candlestick, you can't see what's going on, but all of this is the architecture of that daily range being fulfilled. And it rallies up and clears the buy side. And the news-driven buy side liquidity pool, which is here, gets taken out. Rubbing forward, fair value gap here is an inversion fair value gap. I'm going to go back up one so you can see what that is. Take a look at the price. That's this one here. That reclaimed bearish fair value gap. I'm extending that forward. Okay, that's actually what's going to happen here. And that's this one right here. So what I'm showing you now, inside of this box, I'm delineating at 10 a.m. when the market's bullish, the lunch macro will look for sell side liquidity when it's bullish. And the way you do it is you find 10 o'clock in the morning and you walk forward until you see a prominent swing low or the obvious one since 10 a.m. That's this one right here. You see that? So lunch macro will seek sell side formed after 10 a.m. So it's the first prominent sell side liquidity pool after 10 a.m. That's what it'll reach for. That's this one right here. So we have a drive higher off of that inversion fair value gap that takes out the buy side here. Now the lunch macro, because we're approaching what time? 11:30, it'll start running for the lunch macro. The algorithm will pull back into the range and seek that liquidity right there. So it's lunch macro sell side liquidity. And the buy side here, it runs that first. We have a fair value gap here. It's bearish, trades up into here, hits the consequent encroachment of that gap perfectly, then breaks lower. There's a small little inefficiency that you'll see when we zoom in here. This is a volume imbalance with this candlestick volume imbalance there. Anyway, a small little fair value gap there. And it'll look much more obvious when I zoom in. But for now, I want you to look at what this is. You see that? Look at that. So not only is it a lunch macro, sell side liquidity pool, raid, retracement into the daily range, but all over here to down here, watch, all of this, we're going to zoom into this. This is a fractal. We're going to zoom into that. You're going to see it's my ICT market maker sell model. Low, accumulation, reaccumulation, smart money reversal, low risk sell, distribution, redistribution, second stage. That right there is the best run lower, and it will quickly deliver to the standing liquidity or pending orders below that low. And then it pulls back up into the range that was created from here and here, and basically it became something I'm not interested in the rest of the day. All right, US dollar, it would need to trade higher and then use the inversion fair value gap here. So the market rallies off, comes above, and look at the same quadrants I told you to have on your chart last night. Look what we did at midnight. We rallied up, we dropped down, perfect delivery. Look at that. Rallies up to the consequent encroachment, then drops down, colors outside the lines, accumulates with the bodies right here on that lower quadrant level. That's the lower quadrant of the range between this volume imbalance and that volume imbalance there. That candlestick's open and that candlestick's closed. That's what we're measuring. Put your fib on that on your daily dollar index and post the 25, 75, and the 50 level respectively, and you'll get these levels here. On a 5-minute chart, you can see it rallies up. Look at the bodies respecting consequent encroachment. Look at the candlestick right here on the upper quadrant, and then it sends it. Accumulates more, a small little pause at the bodies respecting the high of that inefficiency, and then rallies up. taking out this high. If you measure the low to this high here and do your standard 0.5 level negative, you'll get around this high here as a swing projection, which is kind of cute. But the sensitivity here, okay, these are not pivots, okay? This is just simply looking at inefficiencies and measuring them and looking at them as the algorithm will. And then on the euro dollar, I mentioned how we ran up here and hit that weekly relative equal highs. The market has pulled back, and we have this gap in here that's being measured with these gradient levels, the lower quadrant, consequent encroachment in the upper quadrant. Over here, this was practical for today because it had already been formed 2 days ago. We have the run here at 2 a.m., creating the sell side liquidity pool, high, runs the high out, so there's a buy side liquidity purge there, and here's Venom. Rally up, one candle, remember I told you it takes one, but it can be a number of candles up here. And then you have a single pass candle down. So up and down, and then we trade up into that candlestick right there. That's Venom. Sells off, inversion fair value gap. There, hits it. And we have a fair value gap here. Breaks down, consolidation in here, measuring gap. Breaks lower, institutional ortho entry drill, which is a gap that only has one little candlestick pop above it like that. Doesn't even go to halfway point. Breaks lower aggressively, takes the sell side and trades down into the fair value gap between these two candles here on this one up close candle. Trades down to it there beautifully there. And then trades back into the middle of the range of this gap between these three quadrant levels right here.